Good morning and good afternoon to everyone. Thank you for joining us today. My name is Amy Dennis, and I'm the head of our retail lending division at Newrez. My co-host today is Ross Olcott, who is head of our joint ventures division. We're proud to be one of the nation's largest mortgage lenders, known for our innovative programs, platforms, strong leadership, and commitment to supporting loan officers with the tools they need to thrive. We're incredibly fortunate to be joined by Barry Habib, a true industry icon. Barry is an American entrepreneur, mortgage and real estate expert, and founder, CEO of MBS Highway. He's a three-time winner of the Crystal Ball Award for the most accurate real estate and mortgage forecasts, and his insights have been invaluable in helping professionals navigate our challenging market with confidence. During his mortgage sales career, Barry personally originated over $2 billion in volume, which is awesome. Today's conversation is all about education and inspiration. This is a unique opportunity to hear from one of the sharpest minds in the business. Please stay on with me after Barry wraps up. We'll have Ross give a quick update on a few of our non-QM products. And with that, please join me in welcoming Barry Habib.
Well, thank you, Amy. That's very kind of you. And Ross, thank you so much. I have some updates to that as well that just kind of happened. So I'll talk about that as we go. But I'm really excited to chat with all of you today because, as you are probably experiencing firsthand, there's a lot of uncertainty. There's been a lot of head fakes for us, right? I mean, we've seen interest rates that look like we were on the cusp of seeing finally rates come back down for us, only to kind of be faked out. And that's happened back in August, September, just recently a couple of times. So it's been a little frustrating. And I don't blame you if you're feeling some of that frustration. But look, a little bit of a spoiler alert here. The message today is that there is some good news ahead. And as a matter of fact, let me bring up the title slide here so you can see that. And I'm going to try and do this a little bit of a different way so we can be a little more interactive here. You tell me, I think that you guys could see me there, right? So the title today is that there is, well, optimistically, but with good reason to be, a new bull market for the mortgage industry. It is closer than you think. And boy, team, it's been over 3 years since we've been frustrated with higher interest rates and just having a little bit of an uphill climb. Doesn't mean you still can't be successful. You sure can. But I think that not only are we going to go over things that will help you get more success and make more income, but we are also going to be, in my opinion, looking at some reasons to be very optimistic about catching a tailwind. Okay, so let's start with the fastest way to increase your income. This is what we all want to do, right? That's why you guys are here listening. Is that, how can I increase my income? And the fastest way to do so, I will tell you, it's relatively simple, and you don't have to spend money. You don't have to make enormous changes. Just really have to be more effective. Close more of the opportunities that you already have. You already are talking with potential referral customers, potential clients. What would happen to your business if a higher percentage of those became transactions or referrals? Just think about that. So how do we do that? Well, there's a few different ways, but a big one is trust. And gaining trust is an absolute game changer. It's that way with family. It's that way with your kids, with your friends. Think about your love life. I think we all can relate to either ourselves or individuals where there wasn't trust at the level that it should have been. I mean, think about how toxic those relationships are, right? Trust is like magic. Everything goes a lot smoother. I mean, we have to memorize a gazillion passwords and whatnot in security. That all slows things down, but that's because of lack of trust. So when there's trust, it is like magic. So how do we gain trust? How do we gain that customer's trust quickly? Well, there's a couple of different ways. One is vulnerability, which is that's another, Amy, you'll have me come back. We'll do a whole other thing on vulnerability. But for today, we're going to talk about gaining trust through knowledge and through education and market expertise. And this is strictly a decision that you have to make, is that you have to decide, are you in the business of information or are you in the business of wisdom? And this is a decision that's up to you, whichever way you decide to go. I think you'll be a lot more successful if you decide to go into the wisdom side. Now, think about information. People don't expect to pay for information, right? You go and you Google something, you're not going to pay for that. But wisdom is something people pay for and expect to pay for and refer towards. So we want to be on the wisdom side of things because technology and AI will make information uh, as ubiquitous as it already is, even more so and more of a commodity. But wisdom is still extremely valuable. So, you think about having an advantage in certain situations. Now, if you remember back in the days where you had to take a test, if you got the questions in advance of the test, well, that's not really fair. It's an unfair advantage for you, but think about how much higher you'd score. Well, you're being tested every day, several times a day, every time you talk to a customer, every time you talk to a referral source. And you can legally have an advantage because you know the questions before they're going to be asked. Think about all of your experience. You know the questions, and they're going to sound something like this. So tell me, is this a good time to buy? Um, is the housing market okay? I'm hearing all these things about, uh, housing market's going to have a tough time. There's a recession. Homes are affordability is an issue. Inventory is going up. Boy, are we going to have another housing bubble like they're talking about on CNBC? And then, what do you think about rates? Which way are rates headed? Now, those questions are coming, right? I originated over $2 billion in loans over a more than 20-year career in the mortgage industry. I got that pretty much every single time. But what's interesting is you in advance of the question being asked, you know what it is. But yet in our industry, so few take advantage of that and they wing it. They are not prepared and scripted and ready for the questions, even though they know it's coming. And they answer the question something like this. Well, yeah, market, that seems pretty good right now. And well, boy, interest rates, if I knew which way rates are headed, I'd be on a I'd be having a pina colada on the beach somewhere. And while that's an answer, did that help you show that you're in the wisdom business? Did that help you gain trust? And did that help you close more of those opportunities that you already have, which is the key to the fastest way to increase income? The answer is clearly no. But what we're going to do today is get you scripted and able to answer that question perfectly and increase your income because you are going to gain trust. Now, what you got to do is you got to stay focused here. Okay. I know your phone's going off. I know your texts are going off. I know your email's going off, but put it aside for the next 45, 50 minutes and take a lot of notes because you're going to need to do that. I want you to take notes so that you can get this dialed in. All right. So here we go. Get ready. I'm going to go fast. So last year when we talked, I have the slide of what we did for our 2024 forecast for last year. And here's what we came up with. We said home price appreciation, 4.5% to 5%. Now, everybody thought we were nuts. And the reason why was because we were just coming off 8% mortgage rates, the worst home price affordability, everybody forecasting 20 to 25% price declines. And here we are, we forecasted 4.5% to 5%. We're kind of on an island, but by every metric, we dialed this in perfectly. And in fact, what it did, Amy, you said 3 crystal ball awards. Well, a couple of weeks ago, I found out that I won a 4th crystal ball for being the most accurate real estate forecaster in 2024. That's 4 since 2017. And I don't do this so I could break my arm patting myself on the back. I do this because the methodologies that I'm going to share with you work and they are very sound and we have a good handle on this. And when I share these with you, you should have confidence in teaching these to your referral sources and your clients because they desperately need to hear them. Now, and by the way, the other years we finished in the top 10. That's out of 150 of the top economists, you name it, Goldman Sachs, Wells Fargo, Bank of America, Morgan Stanley, and here we are, little old us, won it 4 out of the last 7 years. So, okay, let's take a look here. We also said the 10-year Treasury's high would be 4.4. We were wrong, but not by much, by about 0.25%. It was 4.7. We said the high in mortgage rates would be 6.875. We were wrong by 0.25% at 7 1/8. So we missed it slightly, but I think part of the reason was because the job numbers that we kept hearing were incorrect. And the bond market kept getting hammered every time. So in 2024, the numbers reported were 2.5 million jobs, but then they were reconciled and revised down to half of that, less than half, 1.2 million jobs. So I kind of think that if those numbers would have been reported correctly initially, but the bond market wouldn't have bumped up as much as it did. As you know, the bond market's going to get hit when you get a strong jobs number. All right. So what can we expect the rest of this year, and why are we optimistic? Well, one of the reasons is inflation. Inflation has been behaving itself. I think it comes down more. So let's look at what causes interest rate fluctuations. We know the credit risk is a premium, right? So if you have credit that's not as good, you're going to pay a higher rate. You all know that. You also know term premium. The longer I lend you money, or the longer money is lent, the more things can go wrong, which is why a 30-year costs more than a 15-year. That's called term risk premium. And then, of course, there's the inflation premium. So how does that work? Okay, so here we go, team. Now, if you're lending money, let's say you have a fund and you're lending money, and we can use round numbers for conceptual purposes. You lend it out at 7%. If inflation's 3, then you're getting 7% rate of return, but inflation's eating 3. So your real rate of return, and it's called the real rate of return, is 4%, right? 7 is what I'm getting. Inflation takes away 3. My real rate of return is 4. So if you want an approximate real rate of return of 4%, then what happens if inflation goes up? If inflation goes from 3 to 4%, well, then what happens to your rate? Well, if you want a real rate of return of 4, that means I got to charge 8, right? I charge 8, inflation eats 4, I get a real rate of return of 4. But what if inflation goes to 2? Well, then I can get more aggressive. I could charge 6, inflation eats 2, I still got my real rate of return of 4. I want you to understand this because a basic tenet, and it is a real big principle of what drives interest rates. There are other factors. I'm being very, very simplistic here, but I want you to get the basics down so that you can understand the interaction between inflation and why it's so important, and interest rates on mortgages. All right. Now, our Fed chair, Jerome Powell, on the last Fed meeting, he said that without price stability, we cannot achieve the long-term periods of strong labor market conditions that benefit all Americans. So what does this mean? What is he saying? The translation is that inflation for now, inflation is more important than the labor market for now. It's not saying the labor market's not important. Labor market's critically important, but his emphasis is more towards being worried about inflation than the labor market, although both are critically important. Now, where's inflation heading? Well, the government has numbers that lag, and that's a problem. The data takes a long time to get together. There are components in the data that lag, especially when you measure the largest cohort, which is the shelter cohort, rents. There's a very big lag there. So oftentimes it takes about a year for the inflation numbers that you're getting out of the government to reflect what's really going on. Perhaps a better real-time read is trueflation. Now they're saying inflation's around 1.5%, while the government's saying it's closer to 2.5%. So based upon what the disparity is between the two, the point I'm trying to make here is that now things can change, but there appears to be a gravitational pull lower in inflation that, things could change, okay? But on our side is gravitationally inflation should head lower. Now, could things spike up and things change? As I said, yes, of course, but all things equal, ceteris paribus, all things being equal, if we see things relatively stable, inflation should continue to come down, and that's good news for long-term rates. To get a real rate of return, you can go to lower rate. So where do we see inflation? Well, it's currently at 2.6% on core PCE. That's the Fed's favorite measure. We think it kind of hangs around here. Maybe we get a little bit lower, but it's going to be tough to make progress over the next few months. Maybe later in the year or in 2026, we start to see lower inflation, but it's going to be a slog to get it much lower than here. Tariffs is one of the reasons why. Everybody's talking about tariffs, but it's something that we should really understand. Now, tariff could cause a price bump or temporary inflation, but it's different than persistent inflation. Interestingly enough, if tariffs slow down the economy enough, it could actually be deflationary. And you could actually see economic conditions slow down to a crawl. And we're already going to start to see some of that as some of these ships coming in are empty. They've skipped stops coming in from China because once you get over a 50% tariff, you essentially shut down trade. So there's going to be some job losses. There's going to be some economic slowdown. And what we're seeing here is that that is something that could cut both ways with tariffs. You could get a temporary price bump, but it could also slow economic activity, potentially even causing a recession. Of course, this is all in flux as potential for deals could occur. but then it's not like flipping on a switch. It takes a couple of months for that to kind of rejuvenate and get through the system. So there could be a lull in economic activity. Now, there's also dollar strength, which plays a role, because the stronger the dollar, the more you mitigate the tariffs because it buys more foreign goods. But if the dollar weakens, and recently it has, that actually increases the effect of the tariff. But I think we have to understand the tariffs because much of the goods that we import are subject right now to a 10% tariff. So does that mean the price retail goes up 10%? Interestingly, it may not. I want to show you something. So let's just say there's a shirt, okay? And I'm going to make a real easy example here. Let's say the shirt, it costs the importer $10. Now, it's our importer here in the United States. It's not the country that's exporting that pays it. Us, we pay it. The importer pays it. So let's say there's a 10% tariff. So they pay $1. Now, if they mark it up to a wholesaler by $3, now that means that they're going to sell it to the wholesaler for $14. And that wholesaler marks it up to the retail customer and they double the cost, let's say to $14. So the final price to the customer might be $28, $29. But I want you to understand, while it's a 10% tariff here, right? It only changed the price from $27 to $28. Hopefully you guys got that. Maybe $26 to $28. It is not as big of an influence as you might think. Now, there are big ticket items that are completely imported, certain vehicles, that could actually be a 10% tax. So I want you to kind of get your arms around what it truly means. It may not be as big of a cost to the consumer as you're thinking. Now, China, of course, is a different story. And well, as I mentioned, we've kind of cut off right now imports from China pretty much. As soon as you go over 50%, it stops it. So the 145% that is currently in place, that's nothing more than window dressing. So from a tariff perspective, clearly it'd be better if we negotiated deals and we had, this in the rearview mirror. But for now, it could cause a price spike, but it could also cause a recession. Now let's take a look at the job market. As I said, Powell is favoring inflation, but the job market is critically important. And I think the job numbers like we got last month are not really indicative of what's going on. Look, it said 177,000 jobs last Friday. I'm going to call BS on that because they do something called the birth-death ratio. It's completely guesswork and imputed data. And that added about 80,000 jobs of the total. And then revisions were negative 60,000. So this job number was not as strong. I know this number is going to get revised lower. But let's take a look at other factors why we think the job market's not that strong. First of all, people on unemployment, this is the highest level of duration of collecting unemployment benefits in the last 3 years. So if the job market's that strong, why can't you get rehired? Another thing is look at the correlation. The blue line here is the unemployment rate. And we see the brown line, that's the median amount of weeks unemployed. This teal line, that is the average amount of weeks unemployed. And notice how this is moving higher, moving higher. And as you can see, if you go back into the 1940s, every time that happens, the unemployment rate moves up. So the unemployment rate is 4.2%. Our feeling is it moves up. Another reason why we think it moves up is look at job openings. And clearly you can see it's from top left to bottom right. As far as the amount of job openings, less and less and less and less. Now, the government looks at a ratio, and Jerome Powell likes this ratio, and this ratio is called the VU ratio. What it means, it's the ratio of job openings or vacancies to those unemployed. So V's for vacancy, U's for unemployed. That's the VU ratio. It was 2-to-1 less than 3 years ago. So 2 job openings for every unemployed person. Today, it is a 1-to-1 ratio of job openings to vacancies. So this is something that is clearly come down. I think this comes down further, and I think that we will see hiring slow down. In fact, we see the unemployment rate 4.5, maybe 4.6%. Who knows, maybe higher from its current 4.2% level. This is something that I believe is on the way up. It's going to get the Fed's attention, and it's going to bring mortgage rates down. So speaking of the Fed just saw GDP print negative for the first time in 3 years. Now, while they might not consider that a big deal because it's slightly negative and it's 1 quarter, if it persists, you bet it's going to get the Fed's attention. because there is signs of an economic slowdown, and you can't ignore that gross domestic product printed negative for the first quarter. We think the Fed's got to cut 3 times this year. It may start in June. And we think that the Fed funds rate goes from 4.375 currently to 3.625. That's where we see it this year. Now, what does that mean for mortgage rates? Because this is near and dear to your heart. So how does it affect mortgage rates? Well, one thing that's great for us is we've got, in my opinion, the best Treasury Secretary we've ever had for mortgage and real estate. I've met with Scott Besson a couple of times. I've spoken to him. The man is brilliant, and he is really, really sharp on real estate and the mortgage industry. We've never had a Treasury Secretary, Republican, Democrat. I'm not getting politically. I'm just saying this guy is freaking awesome. We've never had one that understands mortgage spreads, that understands unfreezing the housing market, that understands that his job is to keep longer term rates down. And his target, which he shared with me on the 10-year Treasury, is 390. So, that's where are we now? We're at 432. So that'd be nice, 40 basis points less than that. But he also wants to bring mortgage spreads down. And I'll tell you how that all ties in. So he wants to unfreeze the housing market. How's he going to do it? So step by step, he said that he is going to issue more short-term debt. So that's less long-term debt. And he already started doing that today. As a matter of fact, the bond market is doing a little better today. Some of you might have even gotten, I don't know if you got a reprice for the better today, but that's after a 10-year note auction. We should all say thank you to Scott Besson, because since the Fed has started to announce that starting May, they're repurchasing mortgage-backed security, 10-year treasuries, to the amount of $20 billion a month, Scott Besson, is steering them more towards 10-year, so less available, which means they're a premium. And that's what's happening right now. He also has been talking a lot about the bank deregulation. He calls it the bank dereg deal. That does 2 things for us. In a deregulated bank environment, it makes it easier for banks to hold treasuries. So if you have more buyers of 10-year treasuries, then that means that the price of them improves, rates go down. So he's a brilliant man. He understands it. He also is saying that with the bank deregulation, it will also reduce the spread between mortgage rates and the 10-year treasury. More on that in a minute. Now, I had a chance to meet with Elon Musk. The guy's amazing. He's a trip. And I asked him, I said, Elon, right now we're somewhere around 160 billion is what the reports are of savings. How much do you think we could cut from the deficit? Now, team, again, I'm not getting political here. All I care about is how does it affect mortgage rates, okay? So he said to me that he thinks that we could get to $1 trillion. But what he did say that's important, he said, Barry, what is important that you understand is this is not a one-time cut. This is like an annuity. That cut is out there every single year, year after year. And that's a huge deal, because whatever we save, that's less in treasuries that have to be issued. Remember, we spend more than we take in. Our tax revenues, whatever, 4.5 trillion, the spending is somewhere around 6.5 trillion. So we've got a $2 trillion deficit here. And the way we pay for that is by borrowing it. And the way we borrow is by selling treasuries. So any amount less of treasuries that we sell helps the bond market and helps interest rates. Now, I talked about the spread between the 10-year treasury mortgage rates, and Scott Besson is keenly aware of this, and he wants to bring it down to a more normal level. So what's a normal level? I mean, take a look here. You can see, I got my head out of the way there, and you can see that between 1.6, and 2% is pretty much where it's been locked in forever. And then COVID hit, we kind of went crazy. And then we all remember 2023, where they went nuts. Currently, the spread's about 2.6. So we're well above the normal range. But if Scott Besson is successful, the bank dereg deal gets put into play, and we narrow it. So let's say we don't get to 1.6 or 2. What if we get to 2.25? Well, now we could start to come up with a forecast for mortgage rates. So Scott Besson said his target on the 10 years 3.9. I'll tell you why mine is 3.8. If we get lucky, 3.6. It's just because of the technical factors. I'm looking at this as a technician here. And you can see here 3.8 to 3.6 was the low in 2023. 3.8, you bounced off of it and much higher, hit exactly 3.8, hit exactly 3.8, hit exactly 3.8, 3.8 again. And as you can see, 3.8 was a level, and if you break through it, it stops at 3.6. Stays at 3.8, and then boom, off to the races. Now, we did get close to it a few weeks ago. That felt pretty good for about a hot minute. And then, of course, then we went right back up to 460. Here we are in the mid 430s now. Could we get back down to 3.8? I think we can, given inflation comes down, given the job market softens. I think we get all those things that we discussed earlier. We get down to 3.8. And if we do, 10-year treasury gets to 3.8. The spread between the 10-year treasury and mortgage rates goes from currently 2.6 to maybe somewhere in the neighborhood of 2.25. And voila, you could see that our target is in the low sixes. I think we get there. So why is this so important? Well, we learned some lessons. It was short-lived, but we get under 6.5%, and the market gets pretty active. Do you know that at 6%, there's 6 million mortgages that are ready to refinance? 6 million of them. Just to give you some context, the entire purchase market in 2024 was 2.8 million loans. So could you imagine what 6 million loans would do? It would make you feel pretty darn good and pretty darn busy, but you also got to be smart and prepare for it in advance. So we're going to talk about all those things in a minute and how you can capture that. So how does this affect real estate? So real estate is a big thing for us. Your customers ask you, is it a good market? All this negativity about real estate. Let's take a deep dive. So first of all, I wanted to show you the housing market. It's 136 million households, 91 million owned. They're sitting on 37 trillion in equity, averaging 407,000, 45 million rented, zero equity, zero money in households. So the next time somebody says to you, oh, you should rent because rent is cheaper. Really? Is it really cheaper to rent? Okay. Or is that being foolish and short-sighted? It's your job to help these people get in this category and show them some common sense. Now, of those with a mortgage, 35 million of them are free and clear. And I think this is one of the reasons why we've done a very good job in forecasting real estate, because everybody got so hung up on mortgage rates being high and affordability, they forgot that almost 40% of the market is insulated from that. They have immunity from higher mortgage rates because they don't need a mortgage. They're going to buy free and clear. So why we wish they were taking out mortgages to help us, when we exclude that and we say from a forecasting real estate standpoint, 40% of the market doesn't care about rates. That's why the real estate market's been so strong. Now, of those mortgage, 56 million are households have a mortgage, but look at the equity they have. They average 311,000. So as I'll show you, this would be great for cash out refinances. It's also great for when it comes time to make a purchase. Don't take all the proceeds like most people do and put it down on the new home. Eradicate your debts. Most people have debts. Put a smaller down payment, even if you got to take out MI, and your overall payment will be less. So where's the home market going? We average creating 1.8 million households per year. That's the demand side. That's how much our population and immigration growth tells us that we need. These are homes that we need to house people, 1.8 million a year. But how many are builders putting up? Well, how about 1.3 million? So if you need 1.8 and you're building 1.3, what does that tell you? There's going to be upside pressure. Now, of course, people talk about inventory. Now, I like to look at inventory active listings, not regular inventory, because regular inventory could be under contract. So that's kind of off the market. You can't really buy that. So let's look at active listings. And here's the headline you see a lot, and people get concerned. So we're up 30% year over year. That's a lot, 30% year, but it's from very low levels. So if you go April to April, yeah, we're up 30%. But what was it like pre-COVID? Because after COVID, things went crazy. So we have to go back to the same month, April, pre-COVID. The first month, April pre-COVID, was April of 2019. So April of 2019, inventory, as you could see, was much higher. And it's actually, we are currently 16% less inventory than where we were in April of 2019. 16% less. That's a lot less inventory still. But here's the other thing that people forget. Our population has grown by at least 12 million people from 2019 today. And I say at least, okay, because these really just mostly births. So there is clearly still a shortage in households and in available inventory. Now, look, team, betting against real estate, like so many people have foolishly done for so many years, it's not a good bet. Let's look at the last 83 years, because we got data for the last 83 years. And you can see a lot of green here. Those are up years. The red's down years. 77 of 83 years, home values have gone up. 77 of 83, okay? So all these people that forever you hear them chirping. Diana Olick, for the last 10 years, she's been screaming there's a housing bubble. And so many media things to try and get clickbait. 1990, this was less than 1% differential, less than 1%. But okay, it was a down year. But it was all here. And why was this? We got over our skis. No income, no asset, no job, 580 FICO, zero down payment. Heck, what could go wrong, right? too many people were getting homes in this period of time from 2002, 2003, 2004, 2005, and 6, that the housing market pulled forward all of the demand from here with people that really weren't qualified. So we had the correction. Thankfully, mortgage underwriting corrected itself. And since then, housing's been doing beautifully. Now, what if there's a recession? Because you hear this, right? As a matter of fact, realtor.com, you would think realtor.com, they would kind of get it right? But realtor.com says during recessions, home prices decline. Oh, really? How about if instead of clickbait, we go with facts? The shaded areas are recessions. Home values for the last 50 plus years, up, 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 up. This I told you about. This is where the underwriting got a little fuzzy and crazy, but the last one up. So virtually every time you get home values going up. Why? Because interest rates come down during recessions. The unemployment rate does go up, but so many more people are eligible to buy with lower interest rate, it overwhelms those that lose their job during the recession. Our forecast is 4 to 4.5%. On a $500,000 home, it's $25,000 in profit that you make, nothing to sneeze at. So let's review the forecast. You got unemployment 4.4, core PC 2.6, 3 Fed rate cuts, mortgage rates the low sixes would be the low for the year, and home price appreciation 4 to 4.5%. So how do we capture all this? Okay. So here's the thing, is that I started off with this fastest way to increase income, right? Close more of the opportunities you already have. So you got to decide here. Do you want to be in the information game or the wisdom game? So when your customer asks you, now, so tell me, this is a good time to buy. I'm not sure. I'm hearing about this recession and home prices could collapse or housing bubble. I'm not sure what to do here. Should I move forward with this deal? I'm a little nervous about it. And by the way, which way are rates headed? By the way, instead of saying, well, the market looks good, and man, if I'd be knowing which way rates are headed, I'd have a pina colada on the beach somewhere. Ha 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 ha. Instead of that guy, how about this? Get ready. Mr. and Mrs. Client, that's a great question. And you're right. This is a very important decision, often the largest financial transaction people make. So like anything else, real estate's going to depend on supply and demand. And while inventory has gone up in the past year, we're still 16% below where we were pre-pandemic. So it's still tight. In addition to that, you look at the amount of supply that is needed. We need about 1.8 million homes a year. We're only building 1.3 million. So this all bodes well for that. And of course, when you look at some of the demographics that are out there, and you're looking at favorable conditions for supply and demand. But then, in addition to that, there are concerns about what if we have a recession? Well, I'll show you over the last 50 years, you can see, except for that one anomaly, home values go up at an accelerated pace during recession. That's because rates come down during recessions. And if we have one, that's one of the great things about real estate. So, a lot of people also are concerned with real estate values from a perspective of the labor market. And while the labor market may be slowing slightly, we are still at a very low rate of unemployment in the low fours. Now, interest rates, well, it seems like there might be an opportunity there, because from an interest rate standpoint, as interest rates go down, we could see values going up. So it might be a good idea to buy now and then refinance later when rates come down, because inflation, which is a big driver of rates, looks like it's headed in the right direction. If you look at truflation, you're looking at that lower by 1% than where rates are now. So while it's not a guarantee, that bodes well. And with the labor market slowing, the Fed's going to probably look to be making some cuts this year. Now, all this tells us that you're in a favorable position to make this move into a new home. Now, by the way, team, that might have taken 60, 75 seconds. But would you agree with me that I got a lot better chance of gaining trust with that customer than the pina colada guy? I've got a lot better chance of them thinking that I'm coming from a position of wisdom. I've got a lot better chance of them thinking that I am giving them the advice that would hopefully gain their trust and then allow me a greater chance to close more of that opportunity and therefore make more money. If you agree, then you got to make a decision. Now, some of you, please do not roll your eyes and say, oh, Barry, it's easy for you. Look, I didn't give a 3-hour speech. You're talking about 75 seconds. You're telling me you can't learn that? Do you think that when I was born, the doc patted me on the rear end and I immediately started asking questions about the unemployment rate or the Fed? Of course not. These are all learned activities. These are all learned skills. You have the ability to learn them. It is completely your decision if you want to do it. And I got to tell you, the easiest way to do it, just watch the daily update on MBS Highway, spend that 8 or 9 minutes a day, and you will have every answer and you will be sharp as a tack. And it might not happen after one, it might not happen after 10, but after a month or 2 months or 3 months, I promise you, you'll talk differently, you'll be respected differently, you'll close more opportunities differently, and you'll make a lot more money. It's that simple. And you should get the word out there. Look, take this QR code. American Dream TV is something that I have nothing to do with the company, but I do the opening segment for them. It's on CNBC and many other networks. It's phenomenal. People in the mortgage industry that are doing these segments, they not only do they appear on air, they get the notoriety, but they put it on their social media. And then you know what? In the book, The Art of War by Sun Tzu, he says you win every battle before it's fought. What they do is they take their clips, and before they ever meet with the customer or even talk to them, they send this in advance, and the customer knows that they're speaking with someone who is a professional that's known on TV, that knows their stuff. You win more, close more of the opportunities you already have. It's that simple. And you have to understand where the market's headed to. Like on our bond page, this is what I would show my customers when I was originating mortgages. I would say, look, understanding the market's important. We're not robotic where we just lock everybody in, because that, you could, that's a robot does that. You need somebody who's going to help you understand where the market's heading. And as you can see here, when we locked here, we saved 100 basis points in 2 days. And then we floated for how long? 35 days. We gained 309 basis points. That's 0.75%. So if somebody were 1/4% cheaper than me, what they were quoted, I closed you 0.75% cheaper, or netting you a 0.5% difference, and saved you again. And then waited again, saved more money, and repeat the same thing over and over and over and over again. Look, team, what we have to understand is that you start with the customer that you have today, planning for the next deal with them before they close. With every transaction in my career that I have, I established a strike rate, and it made me literally millions and millions and millions of dollars in commissions to me over my career. Millions and millions of dollars. How did I do it? I will share this with you. Please take good notes. Mr. and Mrs. Customer, with a lot of people, the day of closing is where their kind of relationship kind of stops. With me, that's where it starts. See, here at Newrez, what we do is that's where we begin fighting to get you an even lower rate in the future and refinance you and watching the market for you. That's what we do. And that's what I want to do with you now is I want to establish something called a strike rate, because look, I want to show you this here. You see, back in August, look at where prices got to. We haven't been there. Got there in September a little bit. It hasn't been there since. So I don't want where it lasts for a few days to be fleeting. Just a couple of weeks ago, we saw rates drop, but so many of my competitors were not able to help their customers, and so many customers didn't even know they had an opportunity to save hundreds and hundreds of dollars a month for free. That doesn't happen with me. That doesn't happen with Newrez, because what I want to do with you right now is establish something called a strike rate. So let's pick an amount that you want to save monthly. So what is that number? Is that $250 a month? So let's get a rate that corresponds to $250 a month in savings. I don't want you to miss out, because $250 a month, that's $3,000 a year, and over a 5-year period, it's $15,000 of free money. Would you like $15,000 of free money? Yeah, I thought so. So here's what we're going to do. When we hit that strike rate, I'm going to go ahead and lock you in and get you done, because if it only lasts a few hours or a day or a couple of days, I don't want you to miss out. I don't want to hear like if I can't get in touch with you or whatever, I'm going to go ahead and lock you in. So that's what we're going to plan for right now. And then in MBS Highway, we already have all the data. You don't have to do anything. That's the beauty of it. I already know all your buyers. I already know their names. I already know their loan amounts. I know when they closed. I know the type of loan. I know the interest rate they have. And then you have a strike rate that you could put with global settings, whatever it is. We tell you every day where the market is. And when a customer hits their strike rate that morning, 10 a.m. Eastern time, you get an email. Hey, call Stephen, call David, call Andrew. They hit their strike rate. Go call them, go make some money, make these people happy and save them. Guys, couldn't be easier. Take a look at the amount of strike rate notifications. In February and January, pretty much done. But then March 6th, look what happened. We sent out over 4,000 of them. 4,000 of them. If you weren't paying attention, you missed out on that opportunity. And then look what happened April 10th. 9,000. 9,000 opportunities to refinance people. This is what you need to be doing, team. Okay. Pay close attention because you see how fast it drops off. This is what we need to be doing. Just go into MBS Highway. It's all there for you. Pay attention to the strike rate and go capitalize because these opportunities are fleeting. Now, I want to talk to you about another opportunity that you have right now. You could do refinances right now. People say, well, it's not worth it for me to refinance. Why? I got a 3.25% rate. Well, it's true. That's your rate on your 30-year fixed rate mortgage. But do you have any debts? You got a car loan? Yeah, I got a car loan. Okay, so what are you paying? 9.9 on 42,000. Your blended rate's like 4. Do you have credit cards? Heck yeah, I got credit cards. I got store cards. I got major credit cards. So your blended rate is really 6.5%, which is pretty close to where the market rate is anyway. And between your $45,000 in the car and $45,000 in credit cards, you owe over $90,000 in debt. So your total debt is $462,000. So here's what we could do. Look, you bought your home 3 years ago, and I know you got a great rate of 3.25%. And you bought it for $500 with a $400,000 loan. Here's your PITI. It's $2,666. But your home's worth more today, and your mortgage balance through normal amortization has gone down. You got almost $300,000 in equity. You got a 55 LTV now, even though you bought it with an 80 LTV. It's now down to a 55 LTV. That's beautiful. Thing of it is, clearly, it makes no sense to do a rate and term refinance. Obviously not, because at 6.75%, your payment would be $738 more than it is now, and you got to pay $3,000 for closing costs. So we don't want to do a rate and term. But what if we address the debt that you have? You've got debt of $1,000 a month on the car payment, and you've got revolving debt on that $45,000 revolving debt. That's about $2,000 a month. So your total monthly payment between principal and interest, taxes and insurance, and your outstanding debt's $5,700 a month. So let me show you what we could do. See, let's look at your current situation. You have a 75 LTV on your 660 value. We got 495,000 as the loan we could do. Minus the 362 you owe, I've got $133,000 I could pull out in cash. Now, we don't need all of that, but let me give you an example. Now, as I said, your total payment's $5,739 a month right now. And to do a rate and term refi, it would be silly because it would just make your payment go up. You'd be losing money. However, what if we did this? What if we took that $133,000 you had and then take your debts and eradicated them? So let's pay off all your debts. And by doing so, look what happens. We get rid of all your debts. And now your monthly payment drops to $4,046 for everything because you got one payment all in. So you go down from $5,739 to $4,046. You save almost $1,700 a month, $1,693 a month. That's your monthly savings every month. Now, while that's a home run and that's a victory, let me just show you some magic here because truly this is found money, right? You weren't thinking about doing this. You were happy making the $5,700 a month payment. So this is found money. Well, what if we said, hey, let's take that found money and do something special with it. Now, I remember every time I do a refinance for somebody, I could save them money, but they all say, oh, Barry, but then I'm starting all over with a 30-year mortgage. Well, how about if we don't do a 30-year mortgage? How about if we did a 12-year mortgage? Because then your payment's the same. So instead of doing the new mortgage at 30 years, to be exact to the penny, I could do your mortgage at 12 years and 1 month, and it's exactly the same total monthly payment that you're paying now. So instead of the 27 years you got left, you'd only have 12 years and 1 month left. So you're going to save almost 15 years of payments. That's 179 payments that you'd save. Now, just to put that into context for you, let me show you how magical that is. You see, because you don't have to wait 14 years and 11 months to get the benefit. You start every single month from month number 1 saving money. Let me show you and teach you how, because I promise you, your customers have no idea how this works. Here's how amortization works. Your current balance is $362 and you owe debts $99. I propose we roll these in plus $3,000 in closing costs into a new loan of $464. So 5 years from now, they can get your arms around 5 years. Here's what happens. Look at the amortization that happens on your existing loan. You pay your mortgage from $362 to $320 and you get rid of the car payment. So you still have the $56,000 in credit cards because that's unconsolidated. It's revolving. It stays there. So you still owe $376. But because you're on a 12-year amortization, 12 years and 1 month, your mortgage gets paid off over 5 years by $150,000 in just 5 years. That means you only owe $315, or the benefit to you after just 5 years you're making the exact same payment you're making now. You didn't change a thing. You're just doing it smarter. And you're better by $61,000 of free money. Now, let's fast forward another 5 years because it gets really crazy. After 10 years, your balance goes down to 270 on your current mortgage if you kept it the same, plus the debt, you owe 326. But here you've knocked off $357,000 of debt on your mortgage because it's a 12-year and 1-month amortization. You only owe $107,000. You're better off by $220,000, folks. $220,000. Now, let's go to the end of the mortgage, 12 years and 1 month. You owe nothing here on the new mortgage. But if you would have kept that 3.25 mortgage that you love so much, you're going to love it a lot longer because you still owe $248,000 on that, plus your debts. $304,000 would be your balance. This is real magic, team. This is how you create wealth for people. And as good as this is, wait a minute, because I know it's incredible to believe, but it actually gets better. How does it get better? Because after 12 years and 1 month, that's where you start seeing the difference between the continuing payments you would have had to make here versus the zero payments you have here. So there's 179 payments that you still have that you'd have to make on this. So when you take that into consideration on the revolving amount debt saved plus the equity you gained, your grand total is $668,000 benefit. I say that's a pretty good mic drop. So there are people doing this today. There are people helping their customers. They're building equity. They're getting them out of debt. They're saving them years. They're helping them in their retirement, all with rates at 6.75%. So don't think there isn't deals out there for you to have, because there are. Now, what we have here is something I want to show you because there's great tools that show you comparisons on loan comparison. You know, there's total cost analysis tools, this and that. I want to show you our true cost comparison tool because it does everything everybody else does. You can create a video narration, everything, but we do so much more. We have actual real appreciation and forecast data, which nobody else has. And then this answers the question every customer has. Look, you want to be a great communicator, right? So when your customer says, okay, I got these 3 or 4 loan programs, my head's spinning, I don't know, what should I do? MI, monthly MI, annual MI, points, no point, I don't know what to do here. What's best for me? How do you answer that question? Because are you just winging it, or are you a great originator? Are you a great communicator? Because if you're a great communicator, here's how you answer it. Mr. and Mrs. Client, what we like to show you here at Newrez is that all those options potentially could be the best one at different points of time. So what we uniquely can show you is a timeline here. Here's a start, year 1, 2, 3, 4, 5, 6, 7 years, and we can go out as long as you want. But as you can see here, for the first 4 years, this option, 30-year fixed 6.75 with monthly MI, well, that's your best bet. But then between years 4 and 5.25, if you paid 2 points with monthly MI, that would be better. And then if you're going to be there longer than 5 years, well, paying 2 points and upfront MI, that's your best bet after that. You tell me how long you think you're going to be there, and we'll pick the best program for you. And the customer says, oh my God, finally somebody that I can understand. Finally, I could see it and I get it. You need to be that person. Now, are you keeping in touch with your past customers? There are great tools out there. I tell you what, HomeBot is a great tool. Problem with HomeBot is it costs you $200 a month, and that's the starting cost. Then they charge your realtor. Then they charge you for your clients that you add to it. If you build your database, instead of it helping you, it costs you more. With us, you don't have any of that. And the cost is dramatically different from you guys. It's not $200 a month. It's a fraction of that, but we do all the same things. Everybody opens it because how much is my home worth? How much is the forecast? How much equity do I have? What are all these tools to save money? What properties are on the market? Leads to give your realtors. This is exactly what you want to have. So we do even more, but at a fraction of the cost. And then, you get so many tools that you have within there. So look, team, some quick numbers for you. As of April 15th, if you went back for the previous 12 months, the median amount of production for a loan originator, closed loans, $5.2 million. Think about that. Half the originators in the United States did less than $5.2 million in the 12 months ending April 15th. I mean, just think about that, okay? Half did above that. So that's the median. So if you wanted to be taking a look at that number and comparing it to if you were an MBS Highway subscriber, MBS Highway subscribers, they did double that. And the difference is they made $54,000 more. Now you add list reports to it and it gets really crazy. It's $72,000 more. Of the top 100 originators in the United States, 88 are on board here. You should be too. So how much does it cost you? It's stupid not to do it. So HomeBot costs you $200 a month plus. We charge you $169, except not Newrez. Newrez is $69 a month. Like ridiculous. Okay. List reports, it's not $300 a month, which is a steal. It's $99 a month for you guys. MBS Highway, it's not $200 a month, which a lot of people pay. It's less than half of that. And then this doesn't include the subsidies that you receive. So check with your manager, because there's subsidies that you can get too to bring the cost down less. Just email Diana at MBS Highway. Look, bottom line is, you got to make a decision. Do you want to be the very best you can be? Do you want to have the best tools? You want to provide the best advice? You want to be in the best business of being in wisdom and close more of those opportunities and make more money? All the tools are in front of you. It's just a matter of moving ahead and taking the next step. Team, we came in exactly on time. I'm going to leave it to you guys from here. I know it was fast and it was furious, but sending you guys lots of love. I tell you what, I got time for one, maybe two quick question and answers if somebody wants to ask them, and we'll take it from there.
Questions for Barry out there?
Back in the chat.
All right. I think we're good.
You covered it all, Barry. They don't have any questions.
Thank you, guys. Have a wonderful day.
Thank you,
Thanks,
Barry.
guys. Congratulations on your award. Thank you.
Thank you, Ross. Thanks,
guys. Appreciate it. What a great 50 minutes, 52 minutes, we'll say, right on time. But Barry's always great when market forecasts and what's going on. It sounds like we've got some optimistic things when it comes to metrics, but he even said it, right? We've seen these head fakes for the last couple of years. And the main thing that I took out of there, the one thing is, be prepared, or are you just winging it out there, right? That's the big thing. Are you creating those opportunities out there? Are you a mortgage expert, right? Do you know how to explain what's going on in the market? Do you understand that? Or are you just showing up like Barry said? And that's those are things that you can control. You can't control the market, but you can control being prepared, right? Are you prepared for the next downturn in rates? Are you prepared to have those conversations with your client base on rate and term or debt consolidation or whatever, right? I had a loan officer say to me the other day, they said, Ross, I've never met so many people that make a couple $100,000 a year that are broke, right? And that's just with, consumer debt. We all see the same metrics, right? Consumer debt, auto loans, all those at the highest piece. So, the biggest takeaway there is, are you prepared? Are you with a company that's prepared, right? Are you prepared for when, to get up every morning and win? Are you part of that 5.1 number, or do you want to be part of that 15.1 million that's doing business on a daily basis? But so if you don't feel that you have the product, the price, the marketing, the technology, the support to be prepared, reach out to us, reach out to Amy, reach out to myself. Our numbers are up here. Because when it comes to those things, those are staples, right? And one of the things I do want to mention is our non-QM program. We've got a full suite, and Barry talked about being able to take advantage of the opportunities, right? And that's really about saying yes to your referral partner, saying yes to your customers more often than not. And, one of the things I really, amongst many, differentiates us in the industry is our non-QM. We've got a full slate of portfolio products, right? We're doing over $1 billion a year of these products ourselves. We're not brokering them out. These are our products that we're allowing you, to put yourself in a position to say yes, whether that's the full doc, asset-based, bank statements, the SCR loans. We've got a couple of versions of that. So if you'd like to find out a little bit more about that, or if you're interested in possibly, getting more prepared and working under whether the joint venture platform, which, one of the largest in the country of offering platforms, with access to tens of thousands of real estate partners across the country, or more of a traditional branch that you just want to, be able to take your existing business and accelerate it and be more prepared as we go along. Just reach out to Amy or I. Our cell numbers are out there. I'd love to talk to you. If you want to find out more, about a specific product, we'll set up with our, whether it's our non-QM team, our marketing team, whatever it might be, but we'd love to hear from you. So But I appreciate everybody taking the time today. Barry's, fantastic. I always learn more, just from listening to him. So appreciate everyone taking the time, and look forward to speaking to you guys in the future. Thanks, guys.